All right. I believe this is working. Sweet. How's it going, class? Uh, what's up? It's been a little bit. Uh, I'm back. Uh, I enjoyed talking to you guys in class. It's been a good 4 years. So what's up, guys? I yeah. So let's get into it. The goal today is to demystify derivatives, and the main ones I'll be talking about are futures, forwards, puts, and calls. Then I'll also be talking about warrants and in a few slides. But these are the big ones for derivatives. A derivative's value comes from the underlying asset. Now, these assets can be anything, including mortgages, stocks, oil, student debt. It can also be another derivative, which is kind of cool, also kind of scary if you're on margin. But yeah, a derivative is a contract between two parties betting on the price of the underlying asset, which would be mortgages, stocks, oil, student debt. And as the price of the underlying asset changes, the price of the the value of the contract changes also. However, the big difference is that it doesn't change in the same way. So when mortgages go up 1% in value, or like the debt of mortgages go up 1% in value, that doesn't necessarily mean the contract you sign goes up 1% in value. It would probably go up 2, down 1, sideways, might not do anything. So to start off, we'll go a futures contract. Now, a future contract is a contract to buy or sell an asset at a predetermined price on a set future date. You can generally get these on exchanges. They're very standardized. So, example, you can buy 100 of something, 100 barrels of oil, 100 something, and they always end on the Friday of that week, of that trading week. So Friday's a holiday, other than Thursday, but ends Friday. So I could buy a contract that ends next week for 100 barrels of oil at this set price for next week on Friday. So set price, set date. Key features, margins required. It's valued daily. Then it's very common for hedging or speculating. And so pretty much, also they're generally not used for wealth managers, but they are used for massive fund managers that are running hedge funds. They want to hedge either currency risk or hedge some kind of risk by getting a future. So some uses, they very good hedging again. Wheat farmer uses futures to lock in a price to protect against falling wheat prices. They can lock in a set price, set date, set amount. These are typically not used as in a financial advisor's career. So we'll get on to options now. So with futures, you have to buy it. You can sell the contract to someone else, but they have to buy the contract from you. Those oil barrels are going to be delivered. So it's your job to figure out who's going to get them and what's going to happen. Now, an option gives the right, not the obligation, to buy or sell an asset at a set price before or on a specific date. So a call option gives you the right, if you buy it, to buy an asset at a set price on or before a set date. A put option allows you to sell an asset at a set price or a specific date. So if you believe that a company is going to go up in value in the future, you want to buy the right to buy an asset at a certain price at a certain date. If you think something is going to go down in value, for example, you think Tesla next week or in 6 months from now is going to be worth half as much as it is. You can buy the right, you can purchase the right to sell your shares to someone else at a very similar price to today. And it only costs you, I don't know, it depends on a lot of factors, but it won't cost you very much if you think that's going to happen. However, if it doesn't happen, you lose all the money that you spent on buying the option to sell it in the future. So, some more strategies are protective puts. You can buy a put option to protect a stock from downside risk. I'll talk about this one later. You have covered calls. If you own a lot of shares of a stock, you can sell the call option to generate income and limit upside, which does limit upside. And then there's also callers, which combines a protective put with a covered call. It's cap gains and losses. It's very, if you don't think the market's going to move very far, you can sell both. You can, sell a covered call, buy a put option, and it's very limiting in your margins. It's not limiting, but it caps them. So here I'm going to give an example of a protective put. So let's say you are a tech founder or a tech employee. You are one smart cookie. Now, instead of receiving money, you got stock as part of your compensation. And the acquiring firm, who's buying the company that you helped found, imposes a lockup period where you cannot sell your stock for 6 months after the deal is closed. So say they're selling it for $1 billion, you're making $50 million off this deal. Life-changing money. If the company's value of the company goes to like 10% of what it was 6 months from now, you'll have only $5 million. You don't want that. You want to lock in the amount of money you have right now. Say you're like, okay, life-changing money, $50 million. You know what's also life-changing? $45 million. So you're going to buy a protective put spending, I don't know, say $5 million to lock in selling a company stock in the future for $50 million. Does that make sense? Instead of risking it all on one company, whether it goes up and down, you can buy the option to put your shares on someone for a set price. So this not completely, but eliminates significant risk. So here's what I just explained. You can buy a put option, hedging downside risk, and example is a heavy tech founder. Another option is a covered call. We talked about these. These are kind of the purposes. You want to generate income. This one is limiting risk and capital gains and capping gains. All right, now let's get to warrants. Warrants are a long-term call option, are like a long-term call option, but they're issued by the company. So the company gives you the right to buy stock at a fixed price in the future, usually several years. So I'll explain why we don't use them as often as strategies in like wealth management, but overall warrants are pretty much used as a sweetener to lower their debt expenses. So you would like this. We would all like this. Everyone wants the right to get something in the future, or the right to buy a stock in the future for a set price, and if it's above that, you can trigger it. So, and the company wants to sell their stock. Wants someone to buy their debt. A company will attach a sweetener, a warrant, to lower their price of debt. So instead of paying 10% for their debt, maybe they give you a bunch of stock options, a bunch of warrants, and now you pay them 5%. They pay you 5% interest. So because this is debt, they pay you 5% instead of 10%. but you get the stock options. And the company loves this. This very much so helps the company issuing the debt, because they are now able to issue twice as much debt, because just cut their interest expense in half. So they can manage twice as much debt, and all they have to do is give people the option to buy stock in the future, like, I don't know, 5 years in the future. Who knows if the same CEO is going to be around 5 years in the future? So the company really likes this for debt. So warrants are typically not used in a strategy of a financial advisor or their clients. However, they do encounter them in like private equity deals, SPACs, or like structured deals, especially with like accredited clients who like are like offered something and they see it really exciting and they see the warrants. They're like, oh, we get the option to buy the stock in the future. I think it's a good opportunity. We as like financial advisors will come across this as like opportunistic. Like the clients will come off. It's not common. We're not gonna go seek them out as an option, but they do show up. That's what I'll say. Now, here's a little explanation, a little summary of how they're different, how they're used. Warrants, the differences between them. Warrants are pretty much all speculation. You can't really hedge because it's all issued by one company, and if the company goes under, these are worth nothing. Duration, long term. Yeah. So we'll do some questions now. Which statement best explains why futures contracts are rarely used by traditional financial advisors? A. They are illegal for use in retail investment accounts. Nope. B. They are taxed more favorably than mutual funds. Also incorrect. They are complex, it's institutionally oriented, and often not goals based. This is correct. And that's also not correct. But yeah, let's see. They're complex, institutionally oriented, and often the contract sizes are too big for any individual client. So which of the following is the most likely scenario in which a financial advisor would encounter a warrant? 1. Rebalancing a diversified retirement portfolio. Probably not. Hedging short-term market volatility. No, you'd buy puts and calls, or at least if you wanted to hedge short-term volatility. Advising a client invested in a SPAC or private placement. Yes. Yeah, you can offer. You do run into that. Sweet. Last question. A protective put is most useful for a client who wants to generate income through dividend-paying stocks. Not that. Has concentrated stock holdings but cannot sell them yet. We got a winner. So, yeah, keep this in mind. I'll see you guys in class. Well, not in class. I'll see you guys in out in the workforce. So, thanks for being a classmate with me. See you guys.